As the price of things keep escalating in these recent years, hyperinflation is imminent. In developing countries, hyperinflation, which is described as a series of sudden, excessive, and out-of-control price rises, is uncommon. That's because, according to most analysts, real hyperinflation needs an annual inflation rate of 1,000% or more. An annual inflation rate of 2%, according to the Federal Reserve System, or the FRS, is most consistent with the Federal Reserve's mandate for full jobs and price stability. In 2019, the United States inflation rate was 1.81%. For 2020, the estimated rate is 0.62%, and for 2021, it's 2.24%. In 2011, the fastest annual rate of inflation in the United States since 2010 was 3.14%. After making that case, it is important to go through what you can expect in this video. First, hyperinflation is uncontrollable inflation in which the cost of products and services increases at a pace of 1,000% or more every year. Secondly, an oversupply of paper money without a corresponding increase in the demand for products and services will lead to hyperinflation. Thirdly, some say the United States is on the very verge of hyperinflation as a result of previous and potential future government stimulus. Finally, hyperinflation is unlikely according to most experts. Enjoying the video? Remember to hit that like and subscribe button. Thanks. Presence of inflation in a country, and economic equilibrium. Equilibrium is a formal condition of economics in which supply and demand are perfectly balanced. In simplistic words, the amount of goods available for purchase equals the number of people interested in purchasing them. Disequilibrium occurs when economic equilibrium is disrupted, which happens almost all of the time. Inflation is just one potential source of disequilibrium. As inflation causes disequilibrium, prices for goods and services rise, reflecting the supply-demand gap. Inflation reduces the buying value of the capital in the long run. Inflation is the reason that anything that costs $1 today could cost $1.25 next year. What should you know about hyperinflation? Hyperinflation is a unique condition. Inflation on steroids is hyperinflation. The $1 object today could cost $10 or even $50 in a year due to hyperinflation. According to the Anders Slund of the Peterson Institute for International Economics, hyperinflation occurs only in exceptional situations, such as when a currency breaks up during a conflict, when monetary officials lose authority, or when wild populism takes over. Following World War I, the Weimar Republic of Germany saw one of the most striking instances of hyperinflation in all of literature. The German government printed so much money to pay back its war reparations and expand its economy at the same time that a massive difference between supply and demand grew. This resulted in a monthly inflation rate of 322%, or an annual rate of more than 3 billion% by November 1923. So, what is the primary source of inflation in a country's economy? Cost push and demand pull are the two primary sources of inflation, according to economists. When the cost of supply rises, it causes cost push inflation. For example, higher costs of raw materials or wage boosts. As a result, premiums for products and services rise as suppliers pass on their price hikes to the customers. Cost push inflation occurs as increasing manufacturing costs push up prices. When supply is reduced in comparison to the market, demand pull inflation occurs. A good economy, a natural catastrophe, or an oversupply of capital will both increase demand. In these cases, demand outstrips supply, causing prices to rise. What are the factors that contribute to hyperinflation? Hyperinflation is caused by two main factors: a surge in the money supply that is not accompanied by economic expansion, which raises inflation, and demand pull inflation, in which demand exceeds supply. All of these factors are directly related because they both overburden the production side of the supply-demand equation. Political policy, such as what occurred in Germany in 1923, is usually the source of a rise in the money supply. Hyperinflation may occur when the government injects capital into the economy. The demand pull inflationary effect occurs more commonly when consumers have more income, resulting in a desire to pay higher costs, which raises demand. How much would hyperinflation occur? So now you know what hyperinflation is. How often can it happen? Hyperinflations, as seen before, may be fiscally disastrous for a nation. They are, fortunately, very rare. Hyperinflation, according to Slund, is an irrelevant issue for ordinary monetary policy. As the government prints more money in response to a crisis, such as during the Weimar Republic, hyperinflation may occur. There is no need for a conflict to resolve the situation. People hoard for a variety of reasons, including the environment, illness, natural disasters, and even a feeling of fear. Out of necessity, this reduces supply, which raises demand. Hyperinflation can be caused by all of these variables taken to their logical conclusion. However, as Slund points out, under the normal monetary policy, this seldom leads to hyperinflation. Despite this, rumors continue to circulate. Despite the high bar for achieving hyperinflation, some believe the United States is on the verge of doing so. Here are just some of the examples of the reasons why some people believe so. Once investors discover that the US economy is addicted to quantitative stimuli and can't get off the fix, forecasts for the long-term course of the monetary base will be updated upward, potentially leading to the most serious inflationary epidemic in recent US history. The debt-to-outlay ratio exceeds 60%, above the hyperinflationary threshold of 40%. All big nation-state empires eventually collapse, and their citizens lose faith in their governments, as well as the money they issue. It has occurred in ancient Babylon, Egypt, China, Rome, and numerous leading European nation-states, and it will happen in the United States as the American people conclude that they would rather live their lives as free people than as slaves to an unpayable national debt whose interest consumes more of the federal budget than military spending. This then begs the question, is the United States really on the verge of a hyperinflationary crisis? Certain members of the general public may believe this. The majority of officials, on the other hand, say no. Asher Rogovi, an economist, debunks the persistent internet rumor that the United States is printing so much currency that it will result in hyperinflation. Enjoying the video? Remember to hit that like and subscribe button. Thanks. According to Rogovi, in the United States, the central bank does not use the funds it makes to settle the debt in the country. Rather, it loans funds at a set interest rate, and the private sector puts the money to better use. The liquidity that is generated is repaid, which is one of the main reasons why this monetary policy does not lead to hyperinflation. Professor L. Burke Files of the Hyatt Global College believes that hyperinflation is impossible in stable economies such as the United States, thanks to cost-controlled factors enabled by a global economy. The pressure release valve for most nations is the world's integrated existence, Files says. Outliers are countries that print an absurd amount of money, such as Zimbabwe, or attempt to exploit their currency and curb trade, such as Argentina. I don't believe inflation can remain as low as the Federal Reserve's 2% inflation forecast, says Jim Pendergast, Senior Vice President of Altline. However, I doubt we'll see the kinds of hyperinflation predicted in these doomsday headlines. Due to a peculiar series of situations left over from COVID, it'll be a mixed bag. Finally, Solicitor Stephen J.J. Weissman Esquire discusses the scam aspect of certain internet hyperinflation rumors. Sometimes, stories like this are perpetrated simply to be outrageous enough to entice people into reading the stories, which may be posted on sites where they earn advertising dollars based on the number of clicks they receive, Weissman said. So, what's the impact or effect of hyperinflation? In foreign exchange markets, hyperinflation rapidly devalues the domestic currency by lowering its relative value to other currencies. Holders of the domestic currency would be compelled to reduce their reserves and turn to more secure foreign currencies as a result of this situation. Individuals usually begin spending on consumer products such as equipment, machines, watches, and other items to stop paying higher costs tomorrow due to hyperinflation. Individuals may continue to stockpile perishable products in the event of extended hyperinflation. However, this strategy creates a vicious cycle. As markets grow, people collect more commodities, which leads to an increased demand and higher prices. Hyperinflation, if left unchecked, almost always leads to a massive economic collapse. Severe hyperinflation will force the domestic economy to shift to a barter economy, which will affect business sentiment significantly. It has the potential to destabilize the financial system by making banks unable to lend money. Thanks for staying with me till the end. As I'm sure you've enjoyed the video, do let us know your thoughts in the comments section below. Also, please share with others so that they can learn from this interesting and informative video. Also, don't forget to hit the like and subscribe to the channel if you've not done so. This will enable us to send instant notifications to you when we add new superb videos to our channel in the near future. Thank you for your time, and we'll see you in the next video.